Welcome back to our channel. If your business sometimes takes cash as payment for its products or services, a restaurant or a laundromat, for example, or a convenience store, this video could save you a fortune when it comes time to sell. Here's why. If you're liberating cash, meaning not declaring it, it's not showing up on your P&L or your tax return. But you're not just saving a little bit on taxes. You're slashing the value of your business possibly by hundreds of thousands of dollars. In this video, another installment in our What's My Business Worth series, I'll explain how you're losing value, why it matters to buyers and lenders, and what you can do to fix this before it costs you a ton. A lot of business owners, especially in cash-heavy businesses, feel taking a little cash off the top feels harmless. You've worked hard, you pay plenty in taxes, and you feel entitled to the money you've earned. All understandable. So pocketing a little bit of cash seems like it might be small beer. But here's the problem. Every dollar you don't declare, every penny that doesn't show up on your books is a dollar that doesn't exist when it comes time to value and sell your business. You might save a few $1,000s today, but when it comes time to sell, you could lose many times that amount in value. Now, why does liberating cash kill or hurt a value? Well, when we value a business, we start with numbers that can be proven, the numbers on your tax returns and your profit and loss statements. It's from those numbers that we calculate your business's true earnings. Now, whatever your industry's multiple might be, 2, 3, or even 5 times its earnings, it's that number, the business's true earnings, that we apply that multiple to in order to arrive at the business's value. So let's say that after we recast your business's earnings, we show that your business earns $200,000 a year. But then you tell us you're actually taking home another $50,000 in unreported cash, and you'd like to get paid for it. Well, great, we say, except the IRS doesn't know about it, your books don't show it, we can't prove it, and no buyer will believe it. Based on all the financial evidence you've provided, your business has about $200,000 in earnings, not the $250,000 that you now claim. The value of your business, from a buyer's standpoint, as well as from ours, is based on that $200,000. If your business would normally sell for 3 times earnings, the value of that $200,000 is $600,000. But had the missing $50,000 in cash been included, the value of the business would now be $750,000. Hiding that cash just wiped $150,000 off your business's value. You might have saved a few thousand a year in taxes, but you've just erased a 6-figure lump of your business's wealth. Now, this problem also applies to financing. Lenders care only about what can be verified, what's documented, not what you claim without proof. A buyer will not be able to get funded to buy a $750,000 business when the financial documents show a value of only $600,000. So if you expect a price based on true earnings, the value you arrive at will be far higher than the value suggested by the numbers. This is a classic example of the main reason 80% of businesses don't sell when they first come to market. Yours will almost certainly be among that 80%. So how do we fix this? Well, the good news is that it can be fixed. The sooner you start declaring all your income, the faster you rebuild the credibility of your business's true value. Ideally, you want 2 or 3 years of clean, fully reported financials before you go to market. This gives buyers confidence. It helps lenders get on board, and it lets you capture the true value of the business you've built. Now remember from our earlier valuation videos that buyers generally ask the same question. How much will this business put in my pocket? That's what they're buying. You can claim there's $50,000 going into your pocket every year, but a buyer will not pay for anything but provable numbers, not promises. Let's think about this. $50,000 that can't be proven is just as believable as $250,000 that can't be proven. You think there might be a credibility problem here? So, look, we get it. Cash in the door is tough to ignore, and paying taxes just is not fun. But when it comes time to sell, you want to show the biggest, cleanest, and provable number possible. Declaring every dollar might cost you a little more in taxes today, but it can earn you hundreds of thousands of dollars when it comes time to sell. So if you're thinking about selling your business in the next few years, start planning now to close the cash gap and get your books cleaned up and in order. In our next video, I'll detail one of my earliest experiences with the owner of a business in which cash represented a good portion of its revenue. I'll disclose how we found out about it and how we advised the seller what we advised the seller to do to get the full value of his business while keeping his butt out of the crosshairs of the tax authorities. If you found this helpful, hit the like button, and don't forget to subscribe so you don't miss our future videos on valuing, selling, and buying businesses. And check out the What's My Business Worth playlist for more insider tips on valuing and selling your business the right way. Links to that and other resources are in the description below. In the meantime, post a comment. Are you thinking of selling a business? Are you thinking of buying a business? Need some help or some guidance? Let me know in the comments. So until next week, I wish you good health, and I look forward to seeing you in the next video.